What's up, guys? Welcome back. This is the second video in a three-part series of analyzing financial statements. So in the previous video, you saw us analyze an income statement, how to interpret one, and some key things to look for. So if you have not watched that video, I encourage you to do so after this one. I've left a link down in the description below, so please feel free to check that out when you have time. But today is going to be surrounding a balance sheet. So we're going to talk about what a balance sheet is, some key things to look for before investing in a company, because a balance sheet shows what a company has. It basically shows the health of the company, if you will, shows all their assets, shows all their liabilities. Similar to all of us, we have assets and liabilities, with mortgages, car payments are types of liabilities, and we have assets as well. So whether that be our home, our car, precious metals, our furniture in our house, are different types of assets. So companies operate the same way. They have both assets and liabilities. So we're going to walk through some different things to look for in a balance sheet, some different metrics to look at, some different ratios to look at, and some key things to consider before investing in a company. So we're going to take a look at that today. I encourage you to leave me a comment, like this video if you find it interesting. If you want to see me analyze the balance sheet from one of your favorite companies, I'll be more than happy to do so, give you my opinion on that. And I also encourage you to subscribe to the channel, as you'll see regular videos on company analysis. So let's go ahead and hop on the computer and we will analyze the balance sheet for a company. All right, guys, so we're over here on the computer. We're again going to use Microsoft as we analyze their balance sheet from their most recent quarter. First thing you want to look at when looking at a balance sheet is you want to look at your units. So we're in millions except for the per share items. So that first number you see under cash and cash equivalents, that's actually $11.710 billion. So you want to take a look at that. We're also going to look at quarterly data and not annual data. The reason for that is a balance sheet is a snapshot in time. It is the financial standing of a company on a particular date. So in this case, we want to pull that financial information from the most recent quarter, because if we were to look at annual data, things may be a little bit outdated. So we are going to look at the quarter, and the quarter ended on March 31st of this year. So this is Microsoft's most recent financial standing. So if you look at the balance sheet is actually broken down into three sections. You have assets, you have liabilities, and you have stockholders equity. So the accounting equation is that assets equals liabilities plus shareholders equity, or stockholders equity, and those things have to balance. So if you look on the balance sheet, you have total assets, which equals 285,449, and you have the combination of liabilities and stockholders equity, which equals 285,449. So you notice those two things balance. They should balance. That's why it is called a balance sheet. So let's start walking through the balance sheet. I'll show you guys what the different sections are, what all the areas are, and then at the end of the video, I'll give you guys some tips on how to analyze a balance sheet and really understand what to look for and how to understand a company's financial strength, whether or not the company may be a good investment, by looking at some key ratios and some key data from the balance sheet. All right, so we are going to start with assets. An asset is a resource with economic value that an individual or corporation owns with the expectation that it will provide a future benefit. That benefit is to create value for the firm. That can be generating cash flow, reducing expenses, improving sales, regardless of whether it's manufacturing equipment or a patent. So assets are listed on the balance sheet in order of liquidity. You'll have current assets always listed first. Then you'll have other assets or other current assets listed below those, and then just other assets in general below that. So the definition of a current asset is something that can be converted to cash within 1 year. Other assets cannot be converted to cash within 1 year, so that's kind of the difference between those. So you always see the most liquid ones at the top. So at the top you have cash and cash equivalents. So that is cash. So cash is king. We know what that is. Cash equivalents are things like marketable securities, CDs, investment accounts, money market accounts, anything that can be converted to cash relatively quickly. Short-term investments, same thing. Those are marketable securities. And since they are in the current asset class, the expectation is that those marketable securities and those short-term investments will be converted to cash within 1 year. Next, you have accounts receivable. That is net for allowance of doubtful accounts. So what that means is accounts receivable is money that the company is to receive for goods that it has sold on credit to customers. So let's say I sold you an item and you told me you would pay me later. That amount that you owe me goes on the balance sheet as a account receivable. Next is inventory. Inventory kind of speaks for itself. That is the amount of goods that a company has. That can be finished goods inventory, that can be raw materials, that can be work in progress. So that is just all the inventory that a company has. And other current assets are just anything in general, anything that can be converted to cash relatively quickly that a company may own. So those are current assets. You can total all those up, get a value of just over $170 billion. Next, you have property, plant, and equipment minus accumulated depreciation. So property, plant, and equipment is all the property, plant, and equipment that a company owns. So that would be all the machinery, all the buildings, all the infrastructure, everything that it owns and operates kind of goes under property, plant, and equipment. Next on the balance sheet, you see operating lease right of use assets. So this is something you won't see a lot on balance sheets, but for Microsoft's case, an operating lease is a contract that permits the use of an asset but does not convey ownership rights of the asset. So they have use of assets that they do not own. Equity investments, so those are listed on the balance sheet. So those are equity investments that the company owns in other equities. So those are investments that they have. Next on the balance sheet, you have goodwill. Goodwill is an intangible asset that is associated with the purchase of one company by another. Goodwill is the portion of the purchase that the price is higher than the sum of the net fair value of all assets purchased in the acquisition and the liabilities assumed in the process. So Microsoft's got a lot of goodwill on their balance sheet, which that tells me that they've purchased a lot of companies over time, and they have purchased those companies above what's considered fair value. That amount in excess of fair value can be listed on the balance sheet as goodwill. So that's what that is. Next, you have intangible assets. They're not physical in nature. They're things like brand recognition, intellectual property, patents, trademarks, copyrights. Those are all intangible assets. So Microsoft has just over $6.8 billion worth of intangible assets. It says net beside it because intangible assets actually lose value over time via amortization. So that is the net value minus the amortization on those intangible assets. And then last under assets, you have other long-term assets. So that's just anything that the company has invested in long-term, kind of goes in there on that in that area. If you want more information on what some of these other items are, you can always visit the company's most recent filing, whether that be the 10K, which is their annual report, or their 10Q, which is their quarterly report. It'll give you more breakdown as to what some of these other investments are, some of these other long-term assets are. It'll just break things down a little bit further than what's reported in their financial summary. So if you total up all the assets, you get just over $285.4 billion. All right, the next section we're going to come to is the liabilities and stockholders equity section. We're going to focus primarily on the liabilities first, and the first thing we're going to come to is accounts payable. So accounts payable is money that the company owes to suppliers or creditors for goods that they've purchased, primarily like raw materials, think items from suppliers. So what this is something we've bought on credit. So you sell me an item, and I tell you I will pay you later for it. That goes on the balance sheet. That amount that I owe you goes on the balance sheet as an accounts payable. Current portion of long-term debt. So companies have long-term debt that's due over many, many years. Under current liabilities, those are things that are due within 1 year. The current portion of that long-term debt. So not all long-term debt is going to become due at once, but there is a current portion of that will be due this year. So that is the current portion of the long-term debt. Again, similar to assets, liabilities are listed in order that they are due. So anything under current liabilities is expected to be paid within 1 year. The next section we're looking at is accrued compensation. So accrued compensation refers to the amount of liability remaining at the end of a reporting period for salaries that have been earned by employees but not yet paid. So You can see Microsoft does have some accrued compensation, just over $6.2 billion that it's owed to employees. Short-term income taxes is next, so those are income taxes that Microsoft is going to have to pay within this year. All right, next on the balance sheet is short-term unearned revenue. Unearned revenue is money received by a company for a service or product that has yet to be provided or delivered. It can be thought of as a prepayment for goods or services that a person or company is expected to supply to the purchaser at a later date. As a result of this prepayment, the seller has a liability equal to the revenue earned until the good or service is delivered. So in this case, Microsoft is considered the seller. They have a liability equal to the revenue that they've earned on a good or service that needs to be delivered. So that goes on as a short-term liability. Next, you have other current liabilities. Those could just be, it could be really anything, any money that's owed to anybody that's due within 1 year. So you can total up all current liabilities and you have $58.707 billion. Next, you have more what's considered longer term liabilities. So long-term debt, that is debt that the company keeps on its balance sheet, and that is debt that is not due within 1 year. Next, you have long-term income taxes. So those are income taxes that the company has deferred and they're going to be due at some point. So Microsoft has $28.888 billion of long-term income tax going to be due at some point. Long-term unearned revenue, so we talked about unearned revenue up above. So they do have some unearned revenue there as well that's they're not going to pay this year, but will be due some point down the road. Deferred income tax, those are just other income taxes that the company has deferred. Next, you have operating lease liabilities. So this is money that the company owes for leases that it has. And then lastly, you have just any other long-term liabilities that the company is going to have to pay back at some point, but will not have to pay back within the next 1 year. If you total up all the liabilities, you get just over $170.9 billion. All right, the last section of the balance sheet is the stockholders' equity section. And the first thing you're going to see under the stockholders' equity section is the common stock and paid-in capital shares. That amount there, $79.813 billion. What that is the value of the common stock issued plus any paid-in capital by investors, including par value and anything in excess of par value. So if you ever have the chance to set up your own company and determine par value for your stock, it's the amount that's printed on the original stock certificate when they're first issued. Usually companies denote those as 1 cent. So let's say par value is 1 cent for Microsoft and they issue 1,000 new shares. That would raise common stock by $10. However, Microsoft's current price at market price is roughly $195. So issuing 1,000 shares is actually going to bring in $195,000. So for sake of the balance sheet, when they issue 1,000 new shares, cash is going to increase by $195,000 because they're going to get that money from investors by buying those shares. $10 is going to go to common stock because that is the amount of par value times the number of shares issued. And the remaining $194,990 is going to go to paid-in capital or capital surplus. In this case, Microsoft lumps them all together on the balance sheet, and you see that one value of just over $79.8 billion. Next is retained earnings. Retained earnings is the amount of money that's left over after the business has paid out any dividends to shareholders. So money that is left over for the company to reinvest in the business or basically kind of do whatever they want with. And last is accumulated other comprehensive income. Accumulated other comprehensive income includes unrealized gains and losses on reported in the equity section of the balance sheet that are netted below retained earnings. Other comprehensive income can consist of gains and losses on certain type of investments, pension plans, and hedging transactions. It is excluded from net income because the gains and losses have not yet been realized. Investors reviewing a company's balance sheet can use the accumulated comprehensive income as a barometer for upcoming threats and windfalls to net income. So if we saw a big negative number here for other accumulated comprehensive income, that could show investors that there's going to be hits to net income in the future for losses on investments that are not yet realized. All right, so that is a balance sheet in a nutshell. We went through the assets, the liabilities, the shareholders' equity. We talked about the accounting equation, how everything has to balance. So hopefully you guys get a good understanding what each line item means and what to look for and how to read and understand that. So now I'm going to go through and give you guys some tips of some things to look for, what makes a strong balance sheet. So when you're looking to buy stocks, you'll have some tools you can use to really understand and go through a balance sheet and figure out this whether the company is strong financially or very weak financially, and that will ultimately determine your investment choices. So we're going to go through those, and hopefully you guys can get some tools to help you with your investments down the line. All right, guys, we're going to give you some tips for analyzing a balance sheet. We want you to be able to pick out a strong balance sheet from a weak balance sheet, because ultimately that's going to help you guys with your investment choices and where you put your money. So let's go ahead and jump right in. So the first thing we want to look at is liquidity. Liquidity is the ability for the company to pay its bills. So we're going to look at three ratios. The current ratio, the quick ratio, and the cash ratio. Ideally, we want all those to be greater than 1, but we'll go through each one here. So the current ratio is current assets divided by current liabilities. So if we remember from our analysis section, current assets are anything on the balance sheet that's going to be converted to cash within 1 year. And current liabilities are anything that is due, payments due within 1 year. So if we take current assets, divide those by current liabilities, we'd like to see a ratio greater than 1. That tells us that we have more than enough current assets to cover our current liabilities. So if we went ahead and converted all those current assets to cash, we'd be able to pay our bills that are due for this year. So that's something good that we can see. And anything greater than 1 is superb. Quick ratio is the same thing, minus inventory. So you take current assets minus inventory. The reason for that is inventory is less liquid. It's less easily convertible to cash. So if we take that, that gives us that paints a little bit better picture of the company's financial strength with its cash position. And then lastly is the cash ratio. We want to look at cash and equivalents. Sometimes you can also include short-term investments in there. We want to look at those three things and compare those to current liabilities, and that'll tell us if the company actually has enough cash sitting on the balance sheet to cover its financial obligations for the year. So in a future video, I'm actually going to break down a balance sheet looking at debt for a company with a strong balance sheet and a company with a weak balance sheet, and really give you guys an understanding of how to look at debt for a company and understand if it's too much debt given the environment that we're in today. So that'll be coming in a future video. Next thing, we want to look at companies that have enough earnings to pay off all long-term debt within 3 to 4 years. So what that tells us, we're going to look at the balance sheet. We want to look at long-term debt. And then we want to compare that number to the company's annual net income. What we want to see is net income to be able to cover all that long-term debt within 3 to 4 years if the company chose to spend that net income on paying down debt. So that's something good we can see. Next, we want to look at debt ratios. So debt ratios are important, but we really need to take these with a grain of salt, particularly in today's environment. Debt is extremely cheap. Debt financing is extremely cheap right now. Interest rates are at historic lows. They're as low as they've ever been. So companies are taking on more debt. So a lot of these ratios that you're going to run for some of these companies, even big blue chip companies that have been around for a long time and been very successful, have taken on an ample amount of debt over the past several years here, just based on the low interest rate environment. So these ratios have gone up over time. What's more important to me than these ratios is that the company actually has the ability to pay the debt. I'm not so much concerned with them taking on debt if their operations and their cash flows and everything are actually able to fund the debt payments, the interest payments, and everything on that. So in a future video, I'm going to break down all those debt analysis of a company for you and really give you an understanding using all three financial statements. We'll look at the income statement, we'll look at the balance sheet, we'll look at the cash flow statement for a couple popular companies, and really give you guys an understanding how to use all three statements together and understand a company's financial position to be able to pay its debt. But for these, we can look at each one here. Total debt divided by total assets is the debt ratio. So we're going to go ahead and look at that. So the debt ratio in a nutshell measures the extent of a company's leverage. The debt ratio is defined as the ratio of total debt to total assets expressed as a decimal or percentage. It can be interpreted as the portion of a company's assets that are financed by debt. A ratio greater than 1 shows that a considerable portion of debt is funded by assets. In other words, the company has more liabilities than assets. A high ratio also indicates that a company may be putting itself at risk of default on its loans if interest rates were to suddenly rise. A ratio below 1 translates to the fact that a greater portion of a company's assets is funded by equity. So ultimately, in a nutshell, what you want to see with the debt ratio is you want to see something that's less than 1. What that tells you is the company has more assets on its balance sheet than liabilities. Next, we want to look at the debt to equity ratio. So debt to equity is total debt divided by shareholders equity. So we're going to go ahead and look at that now. So the debt to equity ratio is calculated by dividing a company's total liabilities by its shareholders equity. So that's one version. You can also use the version that I've presented here, which is only the company's interest-bearing debt. So that is anything that it has to pay interest on. So all your long-term, short-term debt, notes payable. It's going to exclude things like any accrued compensation or any deferred taxes or any other accounts payable, anything like that. It's going to exclude that. So you can calculate it either way. The numbers are available on the balance sheet. The ratio is used to evaluate a company's financial leverage. The debt to equity ratio is an important metric used in corporate finance. It's a measure of the degree to which a company is financing its operations through debt versus wholly owned funds. More specifically, it reflects the ability of shareholder equity to cover all outstanding debts in the event of a business downturn. So that is the debt to equity ratio. Warren Buffett says that we want to see companies with debt to equity ratios of 0.8 or less. But be aware that it's going to depend widely on what industry you're in. So banks are going to have higher ratios. Certain industries are going to have higher ratios than other utilities. Very debt-intensive industries are going to have higher ratios. So you really need to compare debt to equity ratios and all these debt ratios, for a matter of fact, to the industry that the company's working in. And one thing that you can do on TD Ameritrade is you can actually compare some of these debt ratios. So this one's the debt to capital ratio, which we're going to talk about next. You can actually compare it. You can see where the company's at, and you can also compare it to the industry average. So you really want to compare some of these debt numbers to the industry averages because the number by itself can be fairly meaningless when just looking at a company's balance sheet. So you really want to understand where it stands in the macro environment and the industry environment as well. All right, and the last one, we are going to look at debt to capital, which is total debt divided by total debt plus shareholder equity. So the debt to capital ratio is a measurement of a company's financial leverage. The debt to capital ratio is calculated by taking the company's interest-bearing debt, both short-term and long-term liabilities, and dividing it by the total capital. Total capital is all interest-bearing debt plus shareholders' equity, which may include items such as common stock, preferred stock, and minority interest. So again, this is just another ratio that tells us how much financial leverage the company is using. So you want to look at these three ratios, and like I said, you really want to compare them to the industry and understand how much debt the company's taking on, and really get an understanding of how leveraged their balance sheet is using these ratios. So as noted, total debt in the above equation is all interest-bearing debt, both short-term and long-term. So for the purpose of those debt calculations, we only use interest-bearing debt. So again, I just want to reiterate, a lot of companies are taking on debt right now. Debt necessarily is not a bad thing. We just really want to ensure that a company has a strong financial position, has a lot of cash on hand to be able to pay debt, has enough cash flow and earnings to pay interest on the debt. And we'll go over those in a future debt analysis video of some companies. But those are more important than the overall debt, especially in today's environment when interest rates are so low. All right, next we want to look at assets. So cash should be increasing. You always want to look for cash increasing, cash and investments. However, we want to see inventory increase with cash. We don't want to see inventory increase by itself. A decrease in inventory necessarily isn't a bad thing. It's actually a good thing that can help with cash flows. But we don't want to see inventory increasing at a faster percentage than cash is. So look at the balance sheet and compare those two. And we want to see them growing at the same pace. If you see inventory outpacing cash, that could pose a red flag as a potential investment. We also want to look at cash generation from business operations, not selling assets or bonds. So if you remember from the balance sheet, we got cash and equivalents up here at the top. If a company issues bonds or finances with more debt, let's say they offered $100 million worth of 10-year bonds. Well, cash is going to go up by $100 million. You know, if you look at just cash, you're going to be like, wow, the company just raised $100 million. But down here on long-term debt, that's also going to increase by $100 million. So not only is the company going to have to pay back that long-term debt, but they're also going to have to pay interest on that debt going forward. So just one thing to be aware of. And we also want to look for companies that aren't selling assets. So if we see cash going up, we don't want to see any decrease in any other assets as well. So for example, we don't want to see big decreases in property, plant, and equipment or any other investments or anything like that. We want to see cash generated from business operations and not taking on more debt and not selling assets. All right, so lastly in assets, we want to look for capital expenditures to be less than 25% of net income. Companies without competitive advantages have to use CapEx to stay competitive. They often issue debt financing to pay for it. Companies with competitive advantages don't need to consistently upgrade capital equipment. They simply replace it when it wears out. So you want to look at capital expenditures as a percentage of net income, and we want to see that less than 25%. If we see more than 25%, that could tell you that the company lacks a competitive advantage, and they often have to spend a lot of money to stay competitive in their industry. All right, we're going to look at the shareholder equity section. So first thing we want to look at is for increased retained earnings. So down in the shareholders equity section of the balance sheet, we want to look for increased retained earnings. If a company is not growing its retained earnings, then it's not growing its net worth. However, one thing you'll need to keep in mind is that companies with competitive advantages may have lower retained earnings due to share repurchases and dividend payments. So a company like Microsoft or Apple or some of these big blue chip stocks that spend a lot of money paying dividends and spend a lot of money repurchasing shares, you need to take their retained earnings with a grain of salt because they're choosing to spend their retained earnings and reward shareholders. So you really need to look at retained earnings. Ideally, we want to see those growing over time. So one way you can see that is if you take dividend payouts and share repurchases and add them back to retained earnings and extrapolate that over like a 10-year period and really understand if a company's growing its retained earnings or not. Next, we're going to look at return on equity, which is net income divided by shareholder equity. Generally speaking, higher return equity, the better. Again, this is going to depend on industry. So TD Ameritrade is going to show us the return on equity for different securities, different companies, different stocks. And here we can see that Microsoft has a return on equity of 41.7%. Which is well above the industry average of 16.42%. So you can compare your investment to an industry average to understand if the company is performing better or worse than the industry. And ultimately, if a company is performing better than the industry, more times than not, that's going to be a better investment for the long term. All right, one thing to be aware of with return on equity is if it's very high, we also want to look at the debt ratios for the company, because if the debt to equity ratios are also high, that could tell us that a company is taking on a lot more debt. And although its equity is going up, we need to be cognizant of the company's debt situation. So it's just one thing to be aware of. And one thing to note is that a company cannot grow earnings faster than ROE, return on equity, unless it raises cash via debt or sells more shares. ROE growth rate limits. So it turns out that a company cannot grow earnings faster than ROE without raising additional cash. That is, a firm with a 15% ROE cannot grow faster than 15% annually without borrowing funds or selling more shares. Of course, firms often do raise funds by selling shares or borrowing, but it's at a cost. Servicing additional debt cuts net income, and selling more shares shrinks earnings per share by increasing the shares out total. So just be aware that companies cannot grow earnings faster than return on equity unless there's some type of other financing going on, whether that's equity financing or debt financing. And then lastly, you want to look for share repurchases. Share repurchases are generally a positive thing for investors. It returns some value to investors, and that can raise return on equity. All right, so summing everything up, when you look at a balance sheet, you always want to start with the top-down approach. So you want to look at the macroeconomic environment, really understand what's going on before diving into the balance sheet. So a couple examples of that are right now with what the Fed's done with basically 0% interest rates. Interest rates are at historic lows. Companies are borrowing money at a faster rate than they ever have because interest rates are so cheap. So basically, cash is free right now for companies to finance with debt. So be aware that companies are taking on more debt. So that's why I mentioned earlier that the amount of debt is not necessarily as important right now as the company's ability to actually pay that debt. So we want to look at what's going on in the environment. Also understand what's going on with the consumer, or what's driving the consumer. Is it a good example would be retail. So are more people shopping online right now through Amazon and Walmart and Target's e-commerce platforms? Or are they shopping at stores like Macy's and JCPenney and Pier 1 Imports? So really understand what's driving the consumer before you dig into a balance sheet, because it can tell you a lot by using that top-down approach. So a couple things. We're going to look at what makes a weak balance sheet. So when you look at a weak balance sheet, the first thing you want to look at is negative retained earnings. So what that tells us is a company has generated accounting losses over a prolonged period of time. So that's bad. So what we want to see is retained earnings increasing over time, but keep in mind that retained earnings may decrease if a company is issuing dividend payments or repurchasing shares, but we don't ever want to see retained earnings go negative. Another thing is negative equity. When the deficit in retained earnings surpasses the amount of capital that a company has, that's a red flag, and it says that the company's in distress. So when the company's in distress, it has two options. It can either recapitalize its balance sheet by issuing additional capital by selling common stock or preferred stock, or they can file for bankruptcy is option two. So we don't ever want to see negative equity on the balance sheet. If we do, that could show us that the company is in financial stress. Next is negative net tangible assets. So that's by an excessive amount of goodwill on the balance sheet. So goodwill, as mentioned before, is the amount that's paid above and beyond book value when acquiring a company. While goodwill does have accounting value, it has no economic value. You can't sell goodwill or exchange it for cash. It has to be made up by successfully operating the acquired company. So net tangible assets are equity minus goodwill. If we get a negative value there, that could tell us that the company's carrying too much goodwill on its balance sheet. And lastly, we want to look at the current ratio. As mentioned before, that would tell us anything below 1, that a company does not have enough current assets to cover its current liabilities. So if they went ahead and converted everything they had to cash, they would not be able to cover their bills for this year. So that's what makes a weak balance sheet. So a couple things that make a strong balance sheet, obviously the opposite of all those. But we also want to look for a large pile of cash and short-term investments. If a company is growing its cash and short-term investments over time, that's a positive thing. So we want to look for growth in that. And then we also want to see, as mentioned before, that it's financed by business operations. Our cash is generated by business operations. We don't want to see company issuing more debt to raise cash. We don't want to see a company selling assets to raise more cash. We want to see low or zero to long-term debt. Companies with durable competitive advantages need very little to none for long-term debt. But bear in mind, again, macro view here, that debt's cheap. So companies can often get debt at very low interest rate, and what they do with that debt can often generate returns greater than the interest they pay on that debt. So that's why companies are taking on more debt right now, so just be aware of that. And they also want to see a strong return on equity. So equity investors want to see that they're getting a strong return for their investment. So higher ROE, the better, but just be aware that those should be compared to the overall industry. So Hopefully that gives you guys some tips, some things to look at when analyzing a balance sheet. If you like this video, please give it a thumbs up. If you want me to look at any balance sheets for any specific companies, I can look at those. I can do a video, I can analyze it. And I will be doing a video in the future of analyzing a balance sheet from a couple well-known companies. And just to give you guys an idea of understanding particularly the debt, we want to use not only the balance sheet, but we want to look at the cash flow statement, the income statement, and the balance sheet. We want to use all three together, and we want to really see if a company is able to pay its debt obligations and how to use those and how to interpret those. So hopefully you guys found this video interesting. Please leave me a comment. I encourage you to subscribe. More videos will be coming like this in the future. And please give me a thumbs up. Thanks.